So, what's in store for the global economy in 2026? Well, today we're cracking open Deutsche Bank's big annual forecast. And let me tell you, they're predicting a year of really high stakes and even higher volatility.
The report kicks off with this line: 2026 promises to be anything but dull. I mean, that really sets the stage, right? They're basically telling us to buckle up for a year of huge moves and some serious volatility. So let's dig in and figure out what that really means.
All right, here's how we're going to break it all down. We'll start with why it's going to be such a wild year. Then we'll get into the double-edged sword of AI, a big shuffle in global growth, what central banks are planning to do or not do, and finally, the playbook for investors. Okay, so the main theme of the whole report is this really interesting contradiction. On the one hand, there's a lot of optimism about economic growth, but on the other, there's this expectation of some really sharp, totally unpredictable market swings. So what's behind this balancing act?
And a huge piece of that puzzle, the thing that's really driving this tension, it all comes down to one thing that just dominates the entire forecast: AI. But, as the report makes really clear, artificial intelligence is a classic double-edged sword. This really lays out the two sides of the AI coin perfectly. You've got the AI boom scenario, right? We're talking massive investment, real productivity gains, and earnings growth that spreads way beyond just the tech giants. But then there's the flip side, the AI bust. This is where the hype suddenly turns into fear, and you get the potential for major layoffs, which could obviously put a huge dent in consumer spending and drag the whole economy down. All right, so let's talk about global growth. Now, if you just look at the top-line number, it seems pretty stable. But the real story here is who is doing the growing. The report is forecasting what they call the Great Growth Shuffle, a major shakeup of the world's economic leaders. So first up, the United States. After slowing down a bit, the U.S. is expected to kick back into gear with 2.4% growth. And what's interesting is it's not just about AI. The report points to things like tax cuts putting more money in people's pockets and a little less chaos in global trade.
Now let's head over to Europe, specifically Germany. After being stuck in the mud for years, Germany is actually set for a pretty big comeback. And the main reason for this? A huge new government spending plan, a fiscal stimulus that's expected to get their growth up to 1.5%. Meanwhile, what's going on in China? Well, their growth is actually expected to slow down a bit, but it's still a really strong 4.5%. And the report suggests this is actually a deliberate choice. It's driven by these so-called anti-involution policies, which is a fancy way of saying they're trying to reform their economy from the inside to cut down on all that wasteful, over-the-top competition. And here is a perfect example of that great shuffle we were talking about. India is just on a tear. The forecast says it's on track to blow past Japan to become the world's fourth largest economy in 2026. And they're not stopping there. They've got their sights set on number 3 by 2028. Okay, so with all these economic plates spinning, you've got to wonder, what are the world's central banks going to do? Well, in a word, nothing. Or at least they're hitting the pause button. They are being super cautious right now. And the logic here is actually pretty simple. First, the good news, inflation is finally starting to cool down. But, and this is the key part, it's proving to be really sticky. It's not just going to snap back to the way things were before the pandemic. So the takeaway is that major players like the US Fed and the European Central Bank are just going to wait it out. They're pausing rate cuts for now. And here's what that wait-and-see approach looks like in hard numbers. The forecast projects the U.S. Federal Reserve will end 2026 with its main interest rate hanging around 3.38%. At the same time, the European Central Bank is expected to hold firm at 2%.
All right, now for the part everyone's been waiting for, the billion-dollar question. What does this all actually mean for your money, for investors? Well, the report gets pretty bold with its market predictions. Let's get into it.
Okay, get ready for this, because this is the big one. The headline forecast is for the S&P 500 to hit 8,000. Yeah, you heard that right, 8,000. And they make a point to say this comes from their most bullish analyst, who has a pretty solid track record. Now, this isn't just wishful thinking. It's based on an expectation of really strong corporate earnings growth to the tune of 14.2%. But here's where it gets really interesting. There's a major twist. The report says this whole situation feels a lot like the late 90s tech boom, where you see this huge split between different markets. They think that while stocks are soaring, the credit markets, where companies go to borrow money, could actually get a lot shakier. They expect credit spreads to widen, which basically just means the gap between what safe companies pay to borrow and what risky companies pay gets bigger. And a bigger gap means one thing: investors are getting nervous.
So the rest of the investor playbook really flows from that idea. They're predicting higher government bond yields, with the 10-year U.S. Treasury hitting 4.45%. They also see the U.S. dollar losing some steam against the euro. So when you put it all together, what's the strategy? Their analysts are saying to overweight U.S. and European stocks and underweight stocks from Japan.
So when you step back and look at the whole picture, what do you see? The outlook for 2026 is actually pretty optimistic, especially for economic growth and for the stock market. But, and it's a huge but, that optimism comes with a giant warning label. There's a lot of volatility and instability hiding just under the surface. It's going to be a positive ride, for sure, but a very, very bumpy one.
And that really leaves us with the big question to think about, doesn't it? In a year where stocks might be soaring, but risk is also climbing, how do you find that balance between grabbing the opportunity and still being cautious? As AI changes everything and markets pull in opposite directions, figuring that out is going to be the name of the game.